The global financial community is currently absorbing a development of profound significance, emanating from Iraq's central monetary authorities. A shift that is poised to resonate far beyond the Middle East. What is unfolding is not merely a routine adjustment in foreign exchange policy, but rather a strategically engineered milestone in Iraq's multi-year campaign to fully reclaim and reform its national currency, a movement that major international bodies are now actively acknowledging and engaging with. This calculated transformation is being described by leading economic analysts as arguably the most assertive change in Middle Eastern financial architecture seen in over a decade, signaling a definitive entry into the final critical phase of currency modernization. For those who have been closely monitoring the Iraqi dinar's long-term trajectory, this latest update represents a pivot point, replacing long-standing speculation with a verifiable structure of implementation. This intricate process involves new exchange frameworks and an IMF-aligned roadmap, finally aligning the long-anticipated elements of a complete economic overhaul. The sheer scale and meticulous planning behind this initiative mean that observers must fundamentally reassess Iraq's position in the global trade ecosystem, especially regarding oil and future currency alignments leading into 25. The headline newsmaking waves in financial capitals this week revolves around the quiet but consequential activation of a new currency contract framework within the Iraqi financial system. The core of this mechanism is the introduction of a dual-rate model, an internal structure that distinctly separates the widely reported public market rate from a higher, institutionally applied contract rate. This distinction is far more than a technicality. It represents a major policy implementation. It indicates that Iraq is now operating and testing an internal exchange valuation that is currently exclusive to specific, high-level international trade and government-backed contracts, a rate that has not yet been mirrored on public foreign exchange displays. While casual observers might dismiss this as a minor, localized banking procedure, those with expertise in frontier market economics recognize it as the clear preparatory staging area for a much larger currency adjustment. Experts are characterizing this move as a controlled ignition, the precise kind of preliminary trial that national currencies undergo just before they are intentionally propelled onto a fully flexible global trading stage, officially kicking off a long-prepared revaluation phase. The introduction of this specialized contract rate carries massive implications for Iraq's journey toward financial autonomy. To grasp the concept, consider Iraq's fundamental role as a global oil producer. When Iraq finalizes an agreement to sell crude oil to an international trading partner, instead of simply settling the entire transaction in US dollars, a portion of that energy settlement is now reportedly being executed using the national currency, the dinar. Crucially, this dinar exchange is not occurring at the standard publicly listed interbank rate. Instead, it utilizes the pre-agreed intrinsically stronger internal contract rate. This contract rate effectively functions as a verifiable benchmark, allowing Iraq to systematically assess and normalize the process of trading and settling in its own currency on the international stage. This is a purposeful step beyond simple economic convenience. It is a calculated assertion of monetary sovereignty, designed to elevate the dinar from a domestic note primarily pegged to the dollar to a globally recognized and respected settlement instrument. Further, underscoring the confidence placed in this nascent valuation model, reports have emerged indicating that significant reconstruction and national infrastructure projects within Iraq are also now being settled using this new contract rate framework. The decision by the country's highest financial authorities to apply this system to essential, high-stakes domestic and international dealing sends a powerful signal to global financial institutions about the perceived robustness and sustainability of the new internal valuation. This operational deployment is not theoretical. It demonstrates a real-world stress test of the new value system under substantial economic pressure, signaling that the authorities believe the mechanism is sound and capable of withstanding transactional demands. International financial analysts are increasingly defining this measured progress as a critical turning point in Iraq's modern economic narrative, moving decisively past the era of currency instability. For many years, Iraq's monetary framework operated under strict international observation and required gradual, painstaking steps to restore market credibility, following prolonged geopolitical and economic turmoil. The current series of actions, however, feels distinct and more confident. The scale of the reforms, the meticulous timing of the rollout, and the technical precision of the new exchange adjustments demonstrate an almost perfect alignment with the established reform benchmarks set forth by the International Monetary Fund, IMF. These benchmarks are specifically designed to modernize outdated exchange frameworks and ensure that developing economies are capable of integrating seamlessly into modern, often digital global banking and payment networks. By actively meeting and implementing these stringent standards, Iraq is demonstrating a profound state of readiness, a level of stability, transparency, and fiscal control that warrants a calculated increase in currency rate flexibility, as seen in other successful currency transitions worldwide. This journey of reform involves far more than merely issuing new banknote denominations or achieving impressive foreign reserve balances. It is about a structural, verifiable demonstration to the global community that Iraq possesses the administrative, regulatory, and fiscal capacity to manage its own monetary destiny responsibly and with high effectiveness. The implications of this are not confined to Iraq's borders. The effects are already creating a measurable domino effect across the international financial system. Within a very short period following the internal contract rate announcement, tangible, though subtle, activities began to ripple through the operations of major Tier 1 global banks across North America and Europe. Insiders within the banking sector have observed that these massive financial institutions have begun updating their internal operating systems to incorporate entirely new verification fields, specifically designed to process contract-based foreign exchange transactions. While such system updates could, in isolation, be viewed as standard, routine maintenance, the concurrent timing and specialized nature of these modifications suggest a coordinated, forward-looking preparation. Financial systems do not undergo complex and costly infrastructural modifications based purely on market rumors. They prepare for imminent regulatory changes or anticipated large-scale market synchronization events. Therefore, the conclusion being drawn is that major global financial pipelines are actively preparing the digital infrastructure necessary to seamlessly integrate and synchronize with Iraq's officially reformed currency when it achieves mainstream circulation. Furthermore, these system preparations underscore the profound connection between this contract rate reform and Iraq's broader digital Dinar initiative, a comprehensive program aimed at fully modernizing the nation's banking supply chain. This digital transformation, which commenced in earnest last year, is fundamentally changing how money moves within and out of Iraq. Every financial transfer, every electronic payment, and every cross-border transaction is now subject to sophisticated traceability and compliance checks under this new digital oversight system. This level of financial accountability and comprehensive oversight represents a monumental leap forward. Given that such compliance capabilities were virtually non-existent a decade ago, and it is now a foundational pillar of Iraq's legitimacy in the international financial arena. By deliberately implementing blockchain-style tracking and a high level of digital scrutiny over its monetary supply, Iraq is systematically neutralizing the significant risks posed by black market activities and illicit financial flows that have historically distorted its official exchange rate. This enhanced transparency is the precise reason why sophisticated global investors are now paying acute attention. The combination of a fully traceable, highly compliant currency system, underpinned by continually rising oil output and a stabilizing governance structure, translates directly into investor confidence. In the specialized world of currency revaluation, this restored confidence is recognized as the single most essential precursor to any successful and sustainable rate adjustment. Trust, essentially, must precede the final phase of monetary action. The discussion must inevitably circle back to the economic cornerstone of the nation: oil. Crude oil exports remain the dominant financial engine powering the Iraqi economy. Under the new active exchange structure, Iraq has begun the calculated process of settling a select number of its major international energy agreements directly in dinar, rather than maintaining the traditional exclusive reliance on the US dollar for all transactions. This seemingly minor operational shift holds enormous long-term implications. It means the perceived value and transactional weight of the dinar are no longer solely linked to domestic monetary policies. They are now tied directly to the massive volumes of the global energy trade. Each and every time a major international oil contract is successfully and reliably settled in the national currency, it reinforces the dinar's credibility and its functional status as a genuinely tradable currency on the world stage. This process is akin to a compounding effect of global trust. With every infrastructure deal signed, every shipment of oil verified, and every exchange executed at the stronger internal contract rate, Iraq is adding another essential layer of validation to its currency's global standing. This is precisely how a currency transitions from a regional, domestically focused instrument to a serious, respected contender in the world's major financial markets. One large, verifiable international transaction at a time. An additional, previously misunderstood layer of this transformation is the introduction of smaller currency denominations, such as the 50 dinar note. When these were first circulated, they appeared to be a trivial logistical matter, but they now perfectly align with the broader, meticulously planned currency framework. The necessity for smaller, more manageable notes is a key indicator of preparation for a significant currency value increase. Should the dinar's value rise substantially, high-denomination notes such as the 25,000 dinar note would become impractical for basic, everyday commercial transactions. Introducing these smaller notes in advance ensures that daily commerce remains fluid and practical during the crucial transition phase. This measured and gradual approach, where new denominations are strategically released before any official public rate shift, is a classic and recognized hallmark of an organized, fully coordinated currency revaluation effort. It is a technique used to give domestic markets and the national population ample time to adapt smoothly to the new financial reality, thereby deliberately minimizing the potential for market shock or chaos when the new, internationally recognized rate is finally made public. This is not a matter of financial happenstance. It is a clear example of strategic monetary engineering, signaling to all international observers that Iraq is preparing for a functional, sustainable and controlled rate increase, not a sudden, unpredictable speculative spike. From the broader perspective of the global market, the timing of this critical reform phase could not be more noteworthy. The year 2025 has already seen significant turbulence and systemic challenges in the foreign exchange arena, primarily driven by substantial oil price fluctuations, shifting global interest rate policies, and accelerated debates surrounding de-dollarization among major trading blocs. Iraq's latest bold moves slot perfectly into this evolving global narrative. As a growing number of nations actively seek to diversify their foreign reserve holdings and explore bilateral trade settlements in local currencies, Iraq is aggressively and intelligently positioning itself near the center of this transformation, proving that it can be a vital hub for regional trade. Crucially, Iraq is not attempting to rebel against or undermine existing global financial systems. Instead, it is demonstrating a powerful capacity to evolve strategically within them. By meticulously adhering to IMF protocols and reform mandates while simultaneously asserting its national economic independence through the contract rate, Iraq is signaling a nuanced message. It is capable of operating transparently under international financial rules without sacrificing its monetary sovereignty. This careful and sophisticated balance is precisely what contemporary monetary policy experts define as strategic autonomy, an identity that is rapidly becoming the defining characteristic of Iraq's modern economic posture. Turning to the reaction among international investors, the response has been one of rapidly escalating interest. Over the last few days, major online trading platforms and dedicated global investment forums have registered a distinct and significant spike in detailed discussions centered on emerging market currencies, with the Iraqi dinar as a central point of focus. Although the general retail investor cannot yet access the high-level internal contract rates, institutional power players are already deeply engaged in complex calculations of potential exposure and opportunity. Specialized hedge funds focusing on frontier markets in particular are reportedly exploring avenues to participate in Iraq's massive upcoming infrastructure bond issuances, which are strong candidates to be priced and executed under the new, higher valuation model. The overall sentiment among institutional capital is palpably shifting. What was once characterized as cautious, long-term optimism is now transitioning into calculated near-term positioning. When multi-billion-dollar scale funds begin to undertake granular analysis of a nation's currency reform efforts, it serves as one of the clearest possible signs that the narrative has successfully moved from the domain of rumor and speculation into the undeniable realm of market reality. This professional interest signals a major milestone in the acceptance of Iraq's monetary trajectory. Inside Iraq, the domestic response has been equally energetic and forward-looking. Business owners, especially those directly involved in crucial import and export sectors, are beginning to register a tangible sense of economic momentum and stability. The government's official economic communications offices have been diligent in emphasizing stability and reassuring the populace that the reform process is a deliberately staged and carefully managed, multi-phase effort. This communication is vital because public confidence is the indispensable foundation for any successful currency reform. A currency cannot sustain a revalued state unless the citizens who use it daily have an unwavering belief in its intrinsic strength and future value. Further confirming the thoroughness of the preparation, reports suggest that local commercial banks have already received and implemented critical software updates designed to accommodate new rate structures internally. This proactive measure ensures that when the official public phase of the rate adjustment begins, there will be no debilitating system disruptions or technical failures. This level of comprehensive, forward-looking preparation demonstrates a degree of national foresight and coordinated effort that Iraq has not consistently exhibited in previous years of reconstruction. The tacit, though not always public, involvement of the IMF is evident in this technical synchronization of Iraq's policy steps with established global monetary standards, confirming that the country is using a validated framework for its transition. The core milestones of Iraq's current plan perfectly mirror the exact framework utilized in other successful, historical currency transitions globally. Before any nation can achieve open market revaluation and acceptance, it must first unequivocally demonstrate fiscal discipline, comprehensive transparency, and rigorous anti-corruption controls. Iraq has spent dedicated years strengthening all three of these pillars, evidenced by its foreign currency reserves now well exceeding the $100 billion mark, inflation being kept well within acceptable limits, and the digital traceability of the dinar achieving compliance benchmarks comparable to, or even rivaling, some developed market economies. When these critical metrics align, the IMF generally moves to support a broader international recognition of the currency's adjusted value. Global foreign exchange strategists are already beginning to categorize this moment as a major shockwave event, not because of any immediate sharp market volatility, but because it is successfully introducing a new, highly resource-rich player with verified, credible economic fundamentals into a global landscape that has been overwhelmingly dominated by a small handful of reserve currencies for decades. When a nation of Iraq's strategic importance modernizes its monetary system with such precision, it fundamentally challenges old, established dynamics. Oil buyers are presented with a new, viable settlement currency option. Regional trading partners gain a diversified and trustworthy trading option, and the global market as a whole becomes incrementally less dependent on the dominance of a single reserve currency. The subsequent ripple effect may take time to fully manifest, but it is real, undeniable, and its influence is only increasing in a world of accelerating digital financial exchange. For ordinary holders of the Iraqi Dinar worldwide, the most crucial message remains simple but vital: patience. While the complex infrastructure is being actively tested, verified, and stabilized internally, the public, transactional exchange rate has not yet been officially modified. Engaging in early, unauthorized conversions or being drawn into speculative, unverified exchange offers carries significant risk during this sensitive period. The most secure and advisable approach is to maintain a long-term perspective, remain informed through verified official channels, and wait for the official, public confirmation from recognized financial authorities. When the official revaluation finally occurs, it will be transparently documented, widely publicized, and validated through legitimate official banks. This is not the phase for seeking quick gains. It is the final essential preparation stage, the quiet before the official global announcement, that will ultimately benefit the most patient and informed stakeholders. Looking beyond the immediate transaction, the macroeconomic implications of a successful revaluation and currency modernization are vast. Such an event would immediately boost Iraq's national purchasing power, provide a powerful stimulus to domestic wages, and become a magnet for sustained foreign direct investment. Businesses operating within the country would find international trade, payment processing, and the importation of essential goods significantly streamlined, eliminating major conversion losses. On a broader scale, this move would substantially reshape Iraq's national balance sheet with international lenders, likely leading to reduced borrowing costs and a significant improvement in its sovereign credit ratings. At a regional level, this decisive action could easily inspire other neighboring economies to pursue similar necessary reforms, potentially triggering a domino effect of currency and structural renaissance across the Middle East and beyond. The psychological dimension of this reform on global traders is another layer of consequence. The foreign exchange market is a mechanism driven as much by perception and narrative momentum as it is by pure numbers. When news of this magnitude is formally confirmed, it fundamentally alters the global perception of Iraq, and shifting perception is a powerful catalyst that can reroute massive amounts of capital. Even before any official public rate announcement, the clear confirmation of a working contract rate system signals that Iraq has entered the definitive endgame of its long and challenging reform process. That powerful narrative alone is enough to attract major global attention, draw in sophisticated liquidity, and ultimately precipitate the real, tangible market adjustments that follow. This sequence, numbers and trust working in lockstep, is precisely why currency reform is widely described as both a technical engineering feat and a powerful, psychological event. Perhaps the most intriguing, strategic element of Iraq's current monetary action is the timing. Executing this decisive, final phase in late 2025 positions the nation proactively ahead of the broad global fiscal realignments and digital currency rollouts that are widely anticipated for 2026, when multiple central banks are expected to finalize their digital currency plans and interest rates undergo new cycles. Iraq is not simply waiting for an invitation to this high-stakes, future-focused conversation. It is arriving prepared and ready to operate. By successfully proving its operational readiness now, Iraq ensures that its currency framework is fully compatible and synchronized with all forthcoming global systems. This foresight grants the nation significant leverage when the critical negotiations about digital currency inclusion and international payment interoperability commence next. Your international observers are also highlighting the strategic strengthening of Iraq's economic relationships with its powerful regional neighbors. Trade links with the Gulf Cooperation Council, GCC nations, are demonstrably deepening, and crucial cross-border payment systems are being upgraded to seamlessly accommodate direct dinar settlements, thereby circumventing the historic necessity of using the dollar as an intermediary currency. The closer the dinar's new valuation comes to parity with neighboring stable Gulf currencies, the easier and more efficient it becomes to conduct regional trade. This process of integration is focused on financial efficiency, and in the modern global economy, efficiency translates directly into increased profit, economic growth, and stability. This is the rationale that has quietly secured the IMF's enduring endorsement of Iraq's structured, data-driven, and gradual approach to reform, as opposed to an unpredictable one-time shock event. On the physical ground, the nation's infrastructure upgrades are clearly aligning with this financial metamorphosis. New export terminals, modernized energy distribution grids, and complex logistics hubs are all being designed and built with the explicit capability to handle advanced digital payments and sophisticated multi-currency settlements. Each of these massive construction projects requires rigorous and precise exchange management, which is exactly where the utility of the new internal contract rate framework is proven. It allows the government to lock in predictable, reliable currency values for budgeting and payment purposes, while the central bank continues its final preparations for public rate flexibility. In plain terms, the nation is actively rehearsing the future of its finance before the final global curtain call. Finally, the vital role of public financial education in this immense process must not be underestimated. The Iraqi populace is being systematically and gradually introduced to the concepts of modern banking, the security of digital wallets, and the practicality of real-time electronic payments. The government has dedicated significant resources to promoting financial literacy campaigns that clearly explain how to utilize new digital platforms securely and effectively. This foundational groundwork is absolutely critical, ensuring that when the new adjusted rate becomes public, the population will be ready and confident to operate within the new financial environment. This level of readiness is key to preventing panic, curbing unnecessary speculation, and eliminating hoarding, three destabilizing factors that have historically derailed even the most expertly planned currency reforms. Iraq's leadership has learned from past difficulties, and this time, the internal communication and public preparation strategy appears to be as robust and strong as the underlying monetary policy itself. As the latter part of 2025 approaches, financial attention is now universally turning toward Iraq's eagerly anticipated fiscal report, which is traditionally due at the end of the year. Many experienced analysts believe that this comprehensive report may subtly, yet clearly reveal adjusted reserve valuations, providing a quiet, technical acknowledgement of the internally confirmed, stronger dinar. Should this technical acknowledgement occur, the first quarter of 2026 is widely seen as the highest probability window for the official unveiling of Iraq's new international exchange rate. Regardless of that exact public date, the formal release and ongoing operational use of the internal contract rate framework unequivocally confirm that the structural, irreversible transformation is already well underway. The global financial countdown has demonstrably begun, and the world's major markets are paying close attention.